don't hate the players. Why not utilize our benefits, what we can do to write off our taxes and expand our portfolio and grow financially?
At the end of the day, it all comes down to a personal return. He didn't use a proper tax advisor. He thought he did it all, but he ended up having a tax bill because he was left holding the money. That's not possible because they don't consider it like an active business that it should be.
Hello everyone, welcome to another episode of Paths of Progress. I'm your host Alex Cohn, and today's guest is someone I've personally worked with for the past 3 years. He is a trusted advisor and expert when it comes to navigating the complex world of real estate taxes. Join me is Jay Guttman, co-managing partner at SRG Advisors, a boutique accounting firm that specializes in working with real estate investors. Jay brings over a decade of experience in helping investors like myself reduce taxes and maximize returns. Jay, welcome to the show.
Thank you. Yes.
It's a pleasure having you here. Before we dive into taxes and all that fun world, can you give us a quick overview of your real estate journey? How you got started, what your portfolio looks like today, and maybe touch a little bit of your future plans of expansion, specifically for real estate portfolio ownership.
Perfect. So just the real estate journey, I had family, extended family in the real estate game for a while. So it's always been a passion of mine. I did go the CPA route. So, taxes, there's a reason I'm here. Taxes and real estate have a lot to do with each other. So I decided to specialize in the tax side of the real estate world, as well as investor myself. At the end of the day, it all comes down to a personal return. Even in real estate, pretty much you will have all these entities and the lawyers put all these structures in place. But the tax bill, if there may be a tax bill, comes down to a personal return. And that means money out of your pocket to the government. So it's something that I'm consistently looking out for on my own personal return to try to shield as much as I can from the government, which is what most real estate investors are trying to do as well. So when all these multiple figures come running down into a personal return and trying to shield it, we're all in the same boat trying to maximize tax efficiency to be able to make that next investment, to be able to, of course, have some a little bit more outside of the real estate world, but to build a portfolio and net worth.
I love it. What is your primary focus on real estate and growing real estate as an owner, operator, right?
As an owner. So, no. So right now, it's a lot of syndications. I realized I needed to be 110% in one lane. I wanted to go full, let's call it real estate professional status, but then I couldn't be a CPA, because it's one or the other. You can't give 110% to both. So I decided to double down on the CPA tax route, as well as now possibly do, a bunch of syndications around the US, as well as, let's call it select buildings and properties around the tri-state area that take a lot less of my time on a day-to-day basis. Yes, there's all these investments that could be, Airbnb is very big, short-term rentals. It does take a lot of time, but there are significant tax benefits to that. So I'm doing more of as passive while trying to be active as much as I can, as well as the next deal. I'm presented all the time with clients as well as extended contacts with portfolios that either might need additional investors or full GPs, whatever it is. I'm evaluating those type of transactions on a day-to-day basis. It's significant wealth transfer in the next couple of years, both on businesses that are selling as well as real estate that the family might not want to hold on to a long term. We have a wide array of owners in our tax portfolio that are looking to sell or buy. And it's also who as I deal with a lot of brokers as well, who are also cherry picking deals that they personally buy. There's so much out there.
Wow, I love it. I personally found it that it's super important to work with a CPA who also real estate investor like yourself, and me owning smaller residential real estate, also going the syndication route. It's important to have someone in your teams that knows how to work with those numbers, how to work with those buildings, and it's because a whole different structures there. How has being an investor yourself helped you better serve your clients?
So it's the understanding. When I see it myself on my own personal return, it's the same type of advice and tax strategy and simplicity sometimes. The number one strategy is keep it simple. It's what I want to do. No one wants to complicate their life and pull out the rest of their hair. I don't got much left, but it's keep it simple. The same strategies that I'm implementing is what we're typically pitching our clients. There are many different types of clients, some who have experience. A lot of times it's their first building. They're just getting their feet wet. They need literally 101 on not just business of what a business is, but with the specialty of taxes and how it might impact them. So while seeing it myself and been down that road, you don't fully understand something until you've actually seen it with your own eyes to fruition. From signing contracts, the middle ground to the actual sale or possibly 1031. Until you've been down that road and seen the transactions as it happens, there's a lot to learn.
Absolutely. It's a real estate investor advice 101. Build your team, but build your team with people who are already doing it themselves. Either it's a CPA or attorney or accountant, anyone else in this business that you need in your teams that already have done it before and now they know how to grow, expand, and know the issues that can arise. So they can prepare you for what's going to happen in this space. I love it, Jay. Okay, let's move on to the next question. For investors like myself, taxes are one of the biggest considerations, right? What are the main tax benefits that comes with owning single family and multifamily properties? And I think let's talk about as investment property, not homeowner projection.
Correct. So the number one biggest consideration, the tax laws. Usually you always make a business decision first. Everyone always asks taxes. And yes, super important. But if the deal doesn't make sense, don't do it. And I see this with a lot of real estate. They're like, they want to do deals. They want to buy something. And the current market, we could talk about it. Everyone's got a different view, but some people just don't get paid without doing a deal. But if the deal actually doesn't make sense, it's not a good pick. So the tax laws are written for real estate investors. It's kind of like, once you get a bite of the real estate game, I call it the real estate game, you don't leave. I've had doctors who, I explained to them how the tax laws were written for real estate investors. And this doctor makes a good high 7-figure salary, makes some money, and has a huge tax bill. And I think I was talking to him, or maybe his wife, and his wife turned around like, wait, what? You people who don't pay taxes? And I'm like, yes, by design. The line I use in a lot of my sales pitches, and I think I used it already today, is I looked at Donald Trump's tax return when it was leaked many years ago, and I don't talk politics, but people are like, oh, you didn't pay taxes, and they were all upset. And I looked at it and I'm like, this is a normal client of ours. He's not a client of ours, disclaimer. But I looked at it as this is normal for a real estate investor. The tax laws were written many, many years ago before my time, and they've only been expanded to help real estate investors as time goes on, which is why, we've seen it. A lot of people are getting into real estate over the last XYZ amount of years. It's one of the, let's call it, sexiest professions out there, and money to be made.
As they say, don't hate the players, right? This is what we have. We have structure built by our government. So why not utilize our benefits, what we can do to write off our taxes and expand our portfolio and grow financially? It's just, how things done here. And this is an interesting topic that you touched. How exactly do they write off those taxes? And many investors hear about depreciation, right? This is a main driver of this write-offs, but don't fully understand how powerful it is. Can you explain how depreciation works and why it's such a big advantage for real estate owners?
Yes, so that's the main part of it. A lot of people, they start reading up online and they get the hint of it, and sometimes it's their first time hearing the word depreciation. That doctor I spoke to, he'd never heard of that term before, because even though he's buying an asset here or there on his business and writing it off, it's not like someone who's buying a, let's call it $10 million building and depreciating that $10 million building, let's call it multifamily, over 27 and a half years. They're getting an expense. I call it a fake expense. It's not money out of your pocket depreciation, but it's an expense you get on your tax return. So even though you might be collecting rent and cash flow positive, your tax return will show a loss. And you're like, but I didn't have a loss. That's the way depreciation works. You're able to take, let's call it a phantom expense. So I'm going to make up a number. You buy a big building, you get $100,000 of depreciation. You get to write off that building over time. So let's say that's $100,000. So let's say you collect $100,000, and I'm making it super simple, $100,000 worth of rent. You would think, oh, I have to pay taxes on that $100,000. Most people think that way. But when you have that real estate mentality and you understand depreciation, you collected 100,000 income, you have this $100,000 depreciation expense, which is taking that building and using that expense over between 27 and a half or 39 years. I mean, they're rules. Now your tax bill, your income tax is zero. 100K income, 100K depreciation expense. You have 100K in your pocket, in your bank account, but no tax bill associated. And that's the main part of the real estate investing platform, is utilizing that real estate, utilizing that depreciation number, and of course leverage, which is a whole nother conversation of getting additional depreciation. But even in syndication deals, sometimes if you see a loss, it's not because they actually had negative cash flow. It's because they have this magical depreciation number that has significant tax savings.
Absolutely. And for our listeners who are beginners, depreciation, what it means depreciation. Basically, every building has a life expectancy, and everything inside this building has life expectancy as well. We're talking about plumbing, electricity, we're talking about fixtures, we're talking about cabinets and all the small details, all the way to the shell, roof, basement, whatever can be broken. This is what basically depreciates over the time of the year. For multifamily residential, it's 27 and a half years. And Jay, for commercial building, how many years it is?
39 years for a commercial building. I mean, some of the buildings are hybrids, so you could use a combination of both, but it's typically between 27 and a half and 39 years for the building components. And then, as you mentioned, each component of a building might have a different depreciation useful life. Like the HVAC system, computers, every single thing, there's an IRS chart, 5 years, 7 years. There are multiple different years you would take that expense.
Yeah, and when we're talking about larger buildings, like larger multifamily, there was sometimes that people utilize heavily forced depreciation, right, or expanded depreciation. Can you explain a little bit on that terminology and if it's still available today and what amount?
Correct. So, I mean, you're touching upon like the cost segs, right?
Yes.
Perfect. So the cost segs is all the rage. It's the idea that, normally you'd be able to take 100K depreciation, that example I used before. But let's say you could do a couple of things, possibly get $150,000 expense. Now all of a sudden, if you're a real estate professional, you might not be paying taxes on other income. So it's a multi-prong approach with the idea that you could save not just on your real estate income, but on other income as well. But a cost seg means accelerating the depreciation, getting that number higher in year one. It's all time value of money if you think about it, but we all took the time value of money classes and did the calculations. I'd rather the expense now than in 27 and a half or 39 years from now. So let me do everything I can to get it now. And that's what a cost seg does typically, is that you try to get the expense now versus later. So typically you'll hire a third-party engineering company to go through the building. It is all the rage, and it is a significant tax saving strategy for the right investor. In the beginning when cost seg started, everyone wanted to do a cost seg, and I have many clients who did it. Complete waste of money for them because, I always use this line, you have to call your tax preparer and strategist and CPA to get the right tax advice. You don't go onto Google, pick answer number 3, and thinking that's the right answer for you. Your answer is page 10, answer 8, for your tax situation. Everyone's tax situation is different. So all these real estate investors, let's call it, who might have done a cost seg, just spent some money accelerating an expense that they don't get to utilize. But if you are, let's say, a real estate professional in the real estate game, and we could go on for hours talking about what that means, but able to utilize what a cost segregation is, I mean, you could write off millions of dollars in your income just by having an engineer give you, instead of taking that building over 27 and a half years, let's take a lot of that building components now. So it is a no-brainer for the right real estate operator / investor.
Yes, and I think there's a lot of wisdoms there. Don't jump on every tool in your toolbox and every strategy to improve your taxes. For me personally, remember we had this conversation a couple of years ago when I have a 7-unit that was refinanced and I was considering to do cost segregation study. But after I calculated how much of advantage from this action I will get and how much it costs to me, and it really didn't make sense. at that particular moment. And what I learned later on consulting with other cost segregation specialists and yourself as well, the bigger unit makes more sense. And also it depends how much income you get in this year, right? So do you need to offset those taxes? And if you're an active real estate investor, it should, in the end of the day, it should make sense to do any kind of action, right? Especially if compared, you don't want to waste your time, but you waste your money for something that you're not going to utilize.
Correct. It's all about the planning. A 5-minute call with your CPA, you would have maybe, as an outside investor, might get that answer. Yes, it could be a little bit more of a projection. Can't hurt to ask. Get the answer for your specific needs.
No, I agree. That's why I always call you, Jay, first. So let's talk about common mistakes. What are some of the most common mistakes you've seen in real estate investor make when it comes to taxes, and how can they avoid them?
Correct. So, it's the same for all business owners, and I use this line. It's all about your books. Everyone's like, oh, what's the magic real estate? I want to save on taxes. I recently had a high net worth individual. He's like, what? I need the magic bullet. Everyone's saying they're saving on taxes. And I'm like, you're W-2. That's not happening. But let's say you're a business owner. You need to know, first off, to run your business, but also to understand taxes, how much you make, expenses by category, typically on a monthly basis. It shouldn't be done once a year. I have so many clients who do their books maybe once a year. I use this line all the time. I can't remember what I ate for lunch yesterday. How am I supposed to remember what expense of a repair on my building from last January? You won't remember. And that repair, I had 30 minutes ago, I had a client, I had a $17,000 repair last year. I don't see it on the books. I didn't add it to my books. Well, how's your CPA going to know? Think about it. $17,000 expense they just didn't add to their books because they don't consider it like an active business that it should be. And with every expense you're missing, just think about it. You probably know your tax rate, and they could go up to almost 50% or higher if you're like, let's say a high state city tax bill. So you forget to put $20,000 in your expense categories, just lost $10,000. The easiest thing in the world, just keeping track of your books. So that's the number one. The common mistakes, a lot of people, especially when they start off, they consider it back office. It's maybe not important enough for them to do, but they won't even hire someone externally to do it, which, shooting yourself in the foot. I had a client like that. He, started buying a bunch of buildings in Jersey in emerging areas, didn't have books. After 3 years, I fired him. Why? We didn't file. He didn't have books. Every day, the bank's screaming at him that they couldn't refi or they couldn't do anything without books. And I'm just sitting here like, you don't answer an email or a call. You don't do books. I tried doing it for you. So it's so important. It's business 101. Have your accounting planned and sorted out before you start. So that's what I would say most common mistake. And of course, there's many more mistakes people do. Trial and error. You learn from your first couple of ones. But on that accounting side, it's never too late to take the proper approach with accounting. If you don't have if you're not doing, you could do it yourself so easily online now with so many programs. It's like you should be streamlining just based on your rent collections. Typical rent programs also have an accounting module built in. That's pretty good. You should be utilizing that. I don't say go jump to QuickBooks. QuickBooks is a complicated accounting program. I shoot in Excel and I share it with anyone watching. We call it our Schedule E tracker. E just means you're a rental schedule on a personal return. I call it an Excel model. If you know how to add 1 + 1, you could utilize this Excel. It's by month, it's by category. You collected rent checks from 5 people, put it in rent. It repairs, insurance, taxes. A real estate building has 10, 15, 25 categories. Yes, larger buildings have more chart of accounts, but we're talking about making sure you keep track of 15 high-level categories, and you'll save yourself thousands in taxes.
Yeah, and we are talking about smaller owner-operators. The larger people get, more properties, they have property management. And if property management, you guys should ask about their portfolio statement or some property management application statement. And usually those comprehensive statement, you can just plug in it to give it to your CPA. They already have all income and expenses. You just add in your expenses from your bank just to make sure everything matches, and you're good to go. It's not a rocket science, especially when you have smaller buildings. It's easier to do accounting, like Jay mentioned. And the only thing that I learned for myself, and we had those issues too, I always was late on those books. Did always finish them, but I learned it hard way that I need to do it proactively. And this year, soon you'll get the final books from me this month. So
I always say
that's an
first in,
improvement.
first out. Yeah, that is a huge improvement. That's the way, but it takes years to get there. Sometimes.
Yeah, and learning curve. When I'm trying to catch up, a couple of years, I tried to catch up, like you mentioned, and I remember exactly the expense. I have to find all the text messages from that day, trying to find communication with my property manager at that time, or some repairman that I hired, and just trying to understand what expenses matches there, and just to match it with my banking statements and my expenses. Yeah, it's just it's getting hectic. It's much easier to do it proactively than do it later on in the game. I agree this with you. Very good. So we touched this on a small, and we're talking about if it's in state. Now, if we invest in out of state, for those invest in multiple states or long distance, taxes can get a little tricky, right? What should investors keep in mind when it comes to managing state-specific tax issues? And while we touch this topic, what states you guys operate in as SRG advisors?
So SRG Advisor files, I think, tax returns in almost every state. I mean, there might be a few I can't remember. Is there any one in particular that are worse? Yeah, there are certain states that we have clients who don't want to touch. Last week, I had a client, they're operating in a few. They're like, we do not want to do New York City. Make sure you keep us out of there, which is a loaded question. But yes, there are some states you don't want to be involved in unless you make the business decision that you're going to take that, let's call it, risk and complication. New York, New Jersey, California, Massachusetts. There are states that are tougher to deal with. So before you getting into that state, make an educated decision. If the deal makes sense, of course. If you're an expert in that state, of course. But with every state comes possible tax compliance and filing. You could join this syndication that's involved in, you don't even know. Like, they could be invested in 50 states, and now all of a sudden, and let's say it's material, your personal tax return could be 50 states. I don't really have many like that. We have a lot of complicated tax returns, but not many people have to file in every state. There are many who do. But for real estate, you have to file if you're doing, the state rules are if you're doing business in our state, you have to file in our state. And every state laws are different. But if you own a building in that state, you're typically required to register and file. Register, you're like, well, I'm a Wyoming LLC. I hear that so many times, or Delaware LLC. I don't give law advice, but I always say that the same calls that I have clients spending $2,000+ an hour for a lawyer there that I'm on, same advice I'm going to be giving to clients, and just repeat it. Like, from the billionaire to the 1 to 2 units, it's the same type of setup a lot of times, and real estate tax advice for them. So if you have they're like, oh, I've created a Delaware LLC, but I own a building in New Jersey. I'm like, you still have to file and possibly pay New Jersey. So it's a consideration. It might be worth it to have a 5-minute call. Because I'm thinking about XYZ. They told me I might have filing requirements or something called a composite return. If you're invested, if you're not fully running the deal and you're in a different state, they might file on your behalf. Makes things a lot easier. But all these, as you invest, you'll get familiar with the terms K1s and how many state K1s there'll be. If you're personally invested and you don't really have large partners, you'll be, there'll be franchise or operating filing taxes in each state. It gets very, very complicated very fast. So usually people are investing in these deals because it's going to make a lot of money, and they'll worry about the compliance piece right after. Make sure your CPA is involved in that from day one of planning, and of course on a monthly or quarterly basis to plan for no surprises.
Yeah. No, I agree. So basically, if you invest out of state as a passive investor, usually as active investors, as deals, they provide K1 forms. Depends on the structure, what you guys get a business. But usually it's a partnership return, and you just add it to your personal return in the states that you reside. If you open an LLC, you active investor in that particular LLC in a new state, then you have to file in that particular state, and then in your home state as your residential, where you reside. Very good. I understand that a lot of investors I know interested in 1031 exchanges. They heard of the terminology, but they a little get intimidated by the process. Can you walk us through the basics of 1031 exchange and what key things investors need to know? At what stage they need to connect with CPA to talk about it, and what kind of preparations and about timelines for this particular structure?
So the 1031 is one of the most complicated tax structures slash transactions that can be done. There's reverse 1031s, the regular 1031s. Everything has to be done perfectly. And I always give an example of an existing client that we've had for years who didn't give me a call. The planning should be done months before you're even considering doing a 1031 to see if it's even worth to do a 1031. Many times I'll get on the call and I'll be like, this is way too small of a transaction, pay the taxes and don't do a 1031. Yes, when you're dealing with big real estate, it might be worth it. It's all about the potential basis and the gain involved. But a lot of times I'm like, they hear this word that everyone wants to save on tax money. And I'm like, it's $50,000, which just, some is like the biggest amount of money in the world. But like, they could be in a 0% capital gain bracket. Who knows? Why are they doing a 1031? Call up their CPA months before to even see. And then as the transaction goes, a 1031, it's pretty much, instead of paying the taxes, you're swapping one property for another property. So instead of giving the IRS the gain, you're just moving it on to the second property. There are a lot of complications. It's not just the gain. Most people forget about that. You sell the building for $2 million, you have to replace it for $2 million. Not for your gain of $300K. You have to, and then they're like, well, the bank took the rest of the money. How do I go buy a $2 million building if I sold it and I only got cash of 300? That's just part of the 1031 transaction. You got to figure that out. Call your CPA, your banker, strategize. The rules of a 1031, anyone could go online. There's a lot of rules. You got to identify the property. You got to close within the property of typically 6 months. So there's significant time constraints. So I always bring up the case of the doctor who didn't call me. I found out after he said he did a 1031 exchange. Little did he know that he didn't use a proper, let's call it the tax advisor. He didn't tell me he was doing it. His lawyer didn't know. He botched part of the 1031. So which means he thought he did it all, but he ended up having a tax bill because he was left holding the money. The one piece of advice if you get from this call, do not touch any of 1031 money if you're doing it. This guy happened to be like, I'm holding on to XYZ money. I'm like, that's not possible. You're not allowed to touch any of the money. Like it goes to some other party. It's a whole complicated transaction. But let's say this doctor should have never done a 1031. He was a doctor. So I always say, like, if you're in the real estate game, maybe you have to replace a property with another property. Subsequently, 2 years down the line, this doctor lost the building. He was holding on to a huge, awesome building in the beginning. He had the tax strategy and he's like, oh, I'm going to save money. He 1031 into a building. He lost the building. He should have just either kept the building or paid the gain. But to him, he was trying to make the tax decision first and not the business. He botched the 1031 and then he made it into a bad building and lost it. He was not in real estate. He should have just taken his money and would have been hundreds of thousands of dollars richer instead of trying to do one of the most complicated business transactions that also have time constraints. So people are like, I got to do the deal. Let me do the deal. And he did the deal into a pretty bad deal, which fast forward 2 years, lost it all. So while a 1031 is amazing, our very high net worth clients who do it on a consistent basis are saving hundreds of millions of dollars. And yes, smaller time people who know how to, they have a property. I have a client right now sitting on a ginormous gain, planning out his 1031. This person is in real estate. I've been already identifying the new buildings for years, putting in the offers. He's not just running into a deal. And, he's going to defer. You're not saving today. You're deferring the gain. He's going to defer like his $50 million basis gain on the building. So it's a very smart move to do and to consider for the right person.
Right. If you're a real estate professional, and to return to your first point, you should understand when to utilize it or not utilize it and consult with CPA. In the first examples that you provided, person maybe didn't have any incomes that year, and 50,000 capital tax gains wouldn't make a dent in him. But if he push it for the next 3 years, who knows? In 3 years, maybe he would already was in a different bracket. And when he cash out that building, now he get much bigger liability on that particular property. So that's point number one, very important. And point number two, for that doctor, like you mentioned, he has many other strategies how to get this depreciation. He could have get the money from the building. He want to cash out. It's fine. There's nothing wrong with it, right? Getting your equity out of the equation. And then he could have invested as not passive, but more like on active side in the syndication and locally in his area, and try to utilize this depreciation or get a cost segregation strategy and trying to get this out of new building, but without rolling this money and overcomplicating this with 1031 exchange.
It's a great thing to do for the right person.
Right, and the right scale. Again, it's important knowing your finances, consulting with professionals, with your team. That's why you hire CPA, so that they can consult you on such instances. And I think it's very important to utilize your team because they're all around you.
Correct. We'll give you advice. 5-minute call. That's all it takes sometimes.
For sure. And like we mentioned already about scale and about small investor, as investors scale their portfolios, their tax strategies needs to evolve, right? So what should someone with, say, 10 units know about planning for long-term tax efficiency as they continue to grow? Is there any particular route they need to do, or maybe they have to have one-on-one with you to discuss it further, or nothing else really changes on their life?
So, I mean, it's all about planning. You know, they should... Am I going to be reaching out to a lot of our clients on a quarterly or monthly basis? No. If a client reaches out to me, I show up to that meeting. You know, I don't know which clients sometimes are buying new buildings or when it is. Sometimes the deal only happens every other year. So they should book a meeting before, during, and after the transaction times. Or if they're scaling rapidly, I'm going to be talking to them on a consistent basis. But a lot of times people are hold and not much going on. There might not be a reason to meet with your tax advisor on a monthly basis, quarterly, definitely maybe on a yearly. You know, it can't hurt to just, I always tell clients, let's talk in the summer when I'm a little bit more available. I don't want to have a call on April 14th, unless it's a tax emergency. By the way, there's no such thing as a tax emergency. We're not having a call on April 14th to discuss a building that's not closing in 3 months. But the call should still be booked. You should have a relationship with an advisor and a tax accountant who's going to answer. I always ask clients why they're switching to me, and every prospect call, and they're like, my account doesn't answer me. And I'm like, that's where our expertise, we excel at. How hard is it to answer a client? Yes, if it's a complicated question, but you need to be on calls as your business grows with your advisors. There's no reason there should be surprises if you've done the proper planning. Your cash flow is an issue when you see it in your books right then and there before it really becomes a turn you can't turn around from. Have that conversation, book a call, or even just if you're large enough, our larger clients, we set up monthly meetings with them. And sometimes I don't discuss anything with them. It's more of like, they're large enough that something's happening every month, a refi, a possible 1031. I want to hear about it before it happens rather than after.
Makes sense. And we talk of changing tax laws in our country. What do you think is common for real estate investors, and how can we prepare for it?
So I think the real estate is pretty solid in their future. As I said, the tax laws were written for it. I don't know if the real estate lobby, I'm sure they're great. Do I see the tax laws changing significantly to change, let's call it that real estate game and the depreciation? Probably not. Who knows? But I don't see it changing. The tax laws, pretty much of how it's been going on, is going to stay the same. There are going to be certain changes moving forward. If you've been following 1031s, certain states are going up against it now. They're like, wait, and let's call it, New York City. You own $100 million in New York City. You 1031 into a Florida property, which this happened over and over and over, rinse, wash, repeat. New York City's kind of like, wait, I didn't get any money. And now your building's in Florida and you moved to Florida and I'm never going to get money in the future. So there are a few, maybe not federal, but states who are waking up and being like, you never want to deal with the states. Every state wants a piece of your pie. Even on a tax return, a personal return, it's like, wait, why am I paying state taxes twice? You're not. They're just all fighting for their share, their piece. And in the 1031 world, when you're dealing with a lot of big money in real estate, they all want a piece. And if they're not getting their piece, they're going to try to change the laws to get their piece. So I don't think it changed in New York City yet. It's been on chopping blocks and they've been trying to get a piece. California's been trying to claw back a bunch of certain types of taxes, like, options that were vested and exercised after the move-in dates. So that I see happening in the next many years, where states start taking their chunk. Federally, right now, I think things are going to be calm, especially with the incoming administration, who is real estate centric himself, as well as, paying his legally correct share of taxes, let's call it that, in the real estate world as a real estate professional. I think that's going to stay pretty much the same for a lot of years to come.
Very good. No, yeah, I'm also excited that nothing's gonna change on that front, and that's what I'm hoping. We all hope for it, right? Nothing bad gonna come out, but cannot predict the future. So let's talk about new and experienced investors. So both of them listening, whoever listens, what one piece of advice you'd give them to better manage their taxes and grow their portfolio smarter?
Set up your right team. It's not just a tax advisor, it's your consultants, your coaches. You don't know, I don't know everything. I hired coaches back in the day to teach me on multiple different things I didn't know. And that's the key. You're surrounding yourself with the proper team. You can't do everything yourself. And if you do have that mentality, you're going to get to a point where you're killing your business. And I see it multiple times with multiple businesses where, the person's micromanaging, can't delegate, thinking they can do everything, thinking they're going to save that few dollars on a professional. But had they just put the team in place to do what that professional needs to do, sky's the limit. I've seen companies and real estate grow portfolios and businesses from $1 million to $100 million in a few years. I've seen it. It's normal for me to watch that happen. But that couldn't have happened without the planning and team members in place. No one could do something like that themselves. And so that's what I would say the key is. You need the right lawyer. You need the right real estate investors, platforms, consultants, advisors, brokers. I mean, you go on LinkedIn and you could see the whole team of what entails on a real estate transaction from start to finish. You need to set up your all-star team as well.
Absolutely. I think it's crucial. And everyone, whoever starting or already experienced, one way or another, they come back to that, right? If they had bad CPA or they had bad lawyer, they had bad taste in their mouth. I thought I have a great attorney for quite some time, but then he kind of wasted my time on 2 deals and he didn't produce as fast as as I wanted him. And I feel like I'm not going to use him. I'm going to find someone better with better credibility. But that's how we learn, right? We can learn from expertise and we can get some referrals as we're talking right now to you and listen for their interviews and see how they react. And one of the first things when I interviewed your firm, I remember it like today, I called you and find out if the first thing they ask if you guys actually own real estate yourself, if you have this expertise in your corner. And that was crucial for me. Is like what we mentioned in the beginning. This will be advice from me for everyone listening. Find a proper team with the same exposure. They not only have to be rockstar team, but they have to be working the same niche as you guys trying to expand. They have to have exactly the same experience that you are looking to gain from them. Jay, I have one last question for you. If someone wants to find you online or talk to you and get an advice for tax preparation, I know it's already New Year, how people can find you?
So I'm all over the internet, I usually say. Some people are always asking for a business card, and I'm like, I haven't carried a business card in a while. But typically, is it shooting my team an email, info@srgadvisors.com, or calling the main line 1525-1222, and then they'll get you in touch. We have a streamlined onboarding process to get on a call with me. Typically, we'll want to see prior year's tax returns. I'm not going to get on a call blind. That get to know us meeting is what I call it, is a two-way street. I want to make sure that client prospect is the right for us, and as well as we're the right for them. So I'll typically look at their tax returns before I get on a call, analyze it, have a lot of talking points, and then explain to them the value add that working with SRG and the team that we are can help them grow, and of course, save on taxes.
Perfect. Thank you again, Jane, for coming up.
Thank you. It was a great time.
Always the best time. And to our listeners, thank you for tuning in to Path of Progress. Don't forget to subscribe, leave a review, and share this episode with anyone who could benefit from those insights. See you next time.